Welcome to StokTok's deep dive into Teradyne. Teradyne designs and manufactures automated test equipment used to verify the performance of semiconductors, electronics, and industrial robots. At the time of recording, the stock is trading at 380.38, essentially at its 52-week high of 381.47, having recovered sharply from a 52-week low of 68.24. The RSI 14, a momentum indicator where readings above 70 signal overbought conditions, sits at 70.8. The 50-day moving average of 316.44 is well above the 200-day moving average of 195.3, confirming a strong intermediate-term uptrend. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Teradyne's core revenue engine is its semiconductor test segment, which supplies chip manufacturers and fables designers with the high-precision equipment they need to validate silicon before it ships. That creates meaningful switching costs. Once a customer qualifies a test platform into their production line, the friction of changing vendors is substantial. The company also operates in industrial automation through its Universal Robots subsidiary. The StokTok score comes in at 51 out of 100, a hold signal. Valuation scores 10 out of 20, financial health 16, profitability 17, growth 0, and smart money 8. Now valuation. The question every investor has to answer: are you paying the right price? At the time of recording, Teradyne carries a trailing price-to-earnings ratio, that is, share price divided by the last 12 months of earnings per share, of 109.3 times. That is a steep multiple by any standard. The forward price-to-earnings ratio, which uses consensus earnings estimates for the year ahead, compresses to 60.73 times, implying the street expects a meaningful earnings recovery. The EV to EBITDA multiple, enterprise value divided by earnings before interest, taxes, depreciation, and amortization, a capital structure neutral valuation tool, stands at 75.52 times, again elevated relative to where semiconductor equipment peers have historically traded, which tends to cluster in the 20 to 40 times range. The price-to-sales ratio sits at 19.01 times. In our view, Teradyne's moat rests primarily on switching costs and intangible assets, decades of proprietary test architecture, and deep customer qualification cycles that competitors cannot easily replicate. GuruFocus Value, an intrinsic value estimate based on historical multiples, growth, and return metrics, comes in at 139.91 at the time of recording, implying a margin of safety of negative 171.87%. In plain terms, the stock is trading at a very significant premium to that intrinsic value estimate. Wall Street analysts, at the time of recording, have a consensus mean target of 330 across 17 analysts, with the high at 415 and the low at 250. The current price is already above the consensus mean, which warrants attention. The next earnings report is due April 28 of 2026, with the street expecting earnings per share of approximately 2.11, ranging from 2.05 to 2.28. A near-term catalyst that could reset the narrative in either direction. Market sentiment around Teradyne, as of the creation of this video, leans neutral, with insufficient recent news flow to establish a directional bias. On balance, in our view, the valuation setup is stretched. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist of profitability, leverage, and operating efficiency signals, comes in at 5 out of 9 for Teradyne. That places the company in the middle of the range, not distressed, but not signaling broad-based fundamental momentum either. The Altman Z score, a multi-factor model originally designed to gauge bankruptcy risk, where scores above 3 are considered safe, registers at 27.52. That is an exceptionally high reading, indicating the company faces virtually no near-term financial distress risk. On the debt side, the picture is conservative. Cash to debt stands at 1.14, meaning the company holds more cash than debt on a gross basis. Interest coverage, the ratio of operating earnings to interest expense, which tells you how many times over a company can service its debt, is a remarkable 100.58 times. The current ratio, which measures short-term assets against short-term liabilities, is 1.75, indicating comfortable near-term liquidity. Debt to equity, total debt as a fraction of shareholder equity, is a lean 0.10. The verdict on financial strength is clear. Teradyne's balance sheet is a genuine asset. The company carries minimal leverage and has substantial capacity to weather cyclical downturns or invest opportunistically. Next up, profitability. Is this business actually making money efficiently? We lead with return on invested capital, a measure of how effectively management deploys capital to generate returns, where readings above 10% generally indicate a competitively advantaged business, which comes in at 19.79% for Teradyne. That is a genuinely strong number and is, in our view, the single most important data point in this section. It tells us that for every dollar of capital employed in the business, management is generating nearly 20 cents of return. Moving down the income statement, the gross margin, revenue minus the direct cost of goods, expressed as a percentage of revenue, is 58.22%. That is a high-quality margin profile, consistent with a company selling proprietary, intellectually intensive equipment rather than commoditized hardware. The operating margin, which deducts selling, general, and administrative costs as well as research and development, is 21.59%. Net margin, the bottom line percentage of revenue that flows to shareholders after all costs and taxes, is 17.37%. Free cash flow margin, cash generated after capital expenditures, divided by revenue, is 14.12%. The overall profitability picture is strong. Teradyne converts a meaningful share of each revenue dollar into both reported earnings and actual cash, which provides the financial flexibility to fund research and development, return capital to shareholders, and navigate the semiconductor equipment cycle. Onto growth. Is this business expanding, and at what rate? This is where the data delivers its most sobering signal, and it is the primary reason the StokTok score's growth dimension registers 0 out of 20. Over the trailing 3 years, Teradyne's revenue has grown at a compounded annual rate of just 0.40%. Over the trailing 5 years, that figure barely improves, coming in at 0.60%. To put that in context, the semiconductor equipment sector is widely regarded as a secular growth industry, driven by artificial intelligence infrastructure build-out, advanced packaging, and the proliferation of sophisticated consumer electronics. Yet Teradyne's top-line trajectory over both measurement periods is effectively flat. That divergence between the sector narrative and the company's actual revenue record is something we'd want to understand deeply before sizing a position. Book value per share, which represents the net asset value attributable to shareholders and serves as a proxy for the equity-based management has been able to compound, has grown at 4.40% over the trailing 3 years. That is modest but positive, indicating the company is at least building its equity foundation incrementally. The dividend yield stands at 0.13%, essentially a token distribution that contributes negligibly to total return. The growth picture is the weakest dimension of this story, and in our view it demands explanation. Is this a cyclical trough or a structural limitation? The answer to that question drives much of the valuation debate. Now let's talk smart money. What institutional capital is actually doing with this name? 11 top-tier Guru investors, the category of super investors and long-only funds that GuruFocus tracks through public 13F filings, currently hold positions in Teradyne. A 13F is a quarterly disclosure that institutional managers with over $100 million in assets under management must file with the Securities and Exchange Commission, revealing their long equity holdings. Having 11 recognized gurus on the shareholder register is a meaningful signal that sophisticated, long-duration capital sees something of value here. However, the directional flow from the broader institutional universe is more cautious. Only 6.9% of all 13F filers that cover Teradyne are net buyers at the time of recording. Our threshold for a broadly bullish institutional posture is above 50%. So at 6.9%, the data suggests the majority of institutional filers are either holding steady or reducing exposure, not aggressively adding. Insider ownership stands at 1.15%, a low figure. When management and directors own a small fraction of the company's equity, the alignment of incentives between insiders and outside shareholders is, in our view, weaker than we would ideally like to see. More pointedly, over the trailing 3 months, insiders have recorded 0 purchases and 6 sales. Insider selling is not always a negative signal in isolation. Executives sell for many legitimate personal reasons, but the complete absence of any buying against 6 sale transactions at a price near a 52-week high is a signal we would characterize as warranting caution. On balance, the smart money picture is mixed. Credible long-term holders are present, but near-term institutional flow and insider behavior do not suggest strong conviction at current prices. And finally, the verdict. Let's bring it all together. On valuation, the trailing price-to-earnings ratio of 109 times, an EV to EBITDA of 75 times, and a premium of over 170% to the GuruFocus Value estimate collectively suggest, in our view, that the market is currently pricing in a very ambitious recovery scenario, and the stock is trading above the Wall Street consensus mean target. On financial strength, Teradyne's balance sheet is genuinely excellent, minimal leverage, strong liquidity, and an Altman Z score that signals essentially zero distress risk. On profitability, the business earns its keep with nearly 20% return on invested capital, a gross margin above 58%, and meaningful free cash flow conversion. This is a high-quality operation. On growth, the trailing revenue record is the central concern. Near-flat top-line growth over both 3- and 5-year periods sits uneasily alongside a premium valuation, and we'd want to see evidence of a durable inflection before underwriting the bull case. On smart money, 11 Guru holders provide credibility, but thin institutional buying interest and 6 insider sales with 0 purchases at a 52-week high warrant careful attention. The setup, in our view, reflects a high-quality business facing a meaningful valuation challenge. The thesis requires growth to materialize convincingly. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Teradyne. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.